Ready to dive into the world of interest rates and money market investments?
Sounds exciting.
We're tackling a chapter from Keith Redhead's personal finance book.
Oh, I know that one.
It can get a bit heavy with the formulas, but we're here to break it down.
Make it make sense for everyone.
Exactly.
Whether you're just starting out
Or already a seasoned investor.
this stuff is foundational.
Okay, let's start with simple versus compound interest.
Always a good place to begin.
The book gives this example. You invest £100 at a 10% interest rate.
Okay.
Simple interest, you earn £10 each year. Pretty straightforward.
Yeah, just a flat rate.
But then there's compound interest, and that's where things get interesting.
Yeah, compound interest, that's the real magic.
So explain that.
Basically, you're earning interest not just on your original investment, but also on the accumulated interest from the previous periods.
So it's like interest on top of interest.
Exactly like a snowball effect.
So in year 2, you're earning interest on £110, not just the initial £100. So it's like your money's having babies, and those babies are having babies too.
Uh-huh. I like that analogy, a money-making family tree.
Right.
It's powerful stuff. Even Einstein supposedly called it the eighth wonder of the world.
Wow.
Yeah, over time, those small gains can really snowball into something significant.
That makes a lot of sense.
The key is to start early and let that compounding work its magic.
Now, the book also talks about the annual equivalent rate AER.
Right.
What exactly is that all about?
So the AER helps you compare different investment options,
Okay.
especially when they have different interest rates and compounding frequencies.
Because that can get confusing.
Yeah, imagine one account offers 5% interest compounded annually,
Okay.
and another one offers 4.9%, but it's compounded daily.
It's hard to know which one is actually better.
Exactly. The AER cuts through that confusion.
Right.
It calculates what the effective annual interest rate would be, taking that compounding into account.
So it levels the playing field.
Exactly. So when
Yeah.
you're comparing investments, always look for a higher AER.
Higher AER. Got it.
It means your money's growing at a faster pace.
Okay, that's helpful. Now the book delves into calculating the average compound rate of interest.
Uh-huh.
And I'll be honest, the math kind of made my head spin.
I hear you, those formulas can be intimidating.
But what's the key takeaway?
Why we should even bother with that calculation?
Yeah.
Well, it helps you compare investments that have different interest rates
Okay.
over different periods, gives you a clearer picture of their performance.
So it's like a tool to cut through the noise and make better decisions.
Exactly. It's about making informed comparisons.
Okay, now let's move on to variable versus fixed interest rates.
Okay.
I feel like I have a general idea,
Yeah, most people do.
but can you break it down for us?
Sure, so think of a fixed interest rate like a leisurely train ride.
A train ride?
Yeah, you know exactly where you're going, how long it will take.
Okay.
It's predictable, stable.
Like knowing your interest rate won't change.
Exactly.
Yeah,
You
yeah.
lock it in for a set period.
Okay, so then what's a variable interest rate like? A roller coaster.
Haha, you got it.
Right.
With a variable rate, your return can go up and down.
Oh, because interest rates in the market are changing.
Right. It can be more exciting,
Potentially more profitable.
but it definitely comes with more risk.
So who benefits from each type of rate?
Good question.
Like someone saving for retirement, would they want a variable or fixed rate?
It really depends on your risk tolerance and time horizon.
Okay.
Someone closer to retirement might prefer the security of a fixed rate.
Because they know exactly how much income they'll get.
Right. It helps them plan for their golden years.
Makes sense. But someone younger investing for the long term.
They might be more comfortable with that variable rate roller coaster.
Yeah, they have more time to recover from any dips.
Exactly, and
Yeah.
potentially benefit from those higher returns over time.
Right. But there's that income risk you mentioned with variable rates.
Yeah, you face uncertainty about how much income your investment will generate each year.
So there's a lot to consider.
For sure, it's not a one-size-fits-all situation.
Okay, now let's tackle nominal versus real interest rates.
Okay.
I know inflation is involved here,
It's a key player.
but can you explain it in simple terms?
Okay, let's say you deposit £100 in an account with a 3% nominal interest rate.
Okay,
After a year, you'd have 103 prints.
sounds good.
But here's the catch. What if inflation is also running at 3%?
Uh-oh.
That means the price of goods and services has increased.
Right, so even though I have more money, it doesn't buy me more.
Exactly, your purchasing power hasn't actually changed,
Inflation is like a sneaky thief.
stealing the value of your money.
Right, so that's why we have real interest rates.
Yes, it's the nominal interest rate minus the inflation rate.
So in that example, my real interest rate would be 0.
Exactly. Even though your money grew in that scenario, your purchasing power stayed the same.
That's kind of depressing.
It highlights why we need to consider inflation when we're making investment decisions.
So aim for investments with a positive real interest rate.
Right? You want your money to actually grow in value over time.
Now, I know the UK has two measures of inflation, RPI and CPI.
They could be a bit confusing.
What's the difference between those two?
They both track changes in prices,
Yeah.
but the RPI, the Retail Prices Index, includes housing costs, like mortgage interest payments,
Okay.
and the CPI, the Consumer Price Index, doesn't.
So that means the RPI is usually higher.
Yeah, it tends to be.
So which one is the right measure?
There's not really a right or wrong answer.
Okay.
Both measures provide valuable insights.
So it's more about understanding how they reflect your own situation.
Exactly. For example, if you're a homeowner with a mortgage.
Then the RPI might be more relevant.
Right, because it includes those housing costs.
Okay, so be aware of both measures and consider how they relate to you.
That's the key takeaway.
Now let's move on to something that always trips me up. Interest rates versus discount rates.
Ah, yes, they sound similar, but they're not quite the same.
Right. A 10% discount isn't the same as a 10% interest rate.
Nope.
Can you illustrate that?
Imagine you have a chance to buy a £100 bill for £90.
Sounds like a deal.
It is. That's a 10% discount.
Okay.
But if you invested that same £90 at a 10% interest rate,
Yeah.
you'd only earn £9 in interest, ending up with £99.
Ah, I see. With the discount, you're getting a slightly higher return.
Exactly, because it's calculated on that full £100.
So discounts can be more advantageous than they seem.
Yes, especially with investments like treasury bills, which rely on discounts.
Now let's talk about bonds, specifically interest yield versus total return.
Okay.
Why do bonds have two sources of return?
Well, bonds are kind of like a hybrid investment.
Interesting.
You receive regular interest payments. Those are called coupons.
Okay.
And the bond's price can also fluctuate in the market.
So you could have capital gains or losses.
Exactly. So your total return is a combination of both.
Makes sense. It's like owning a property and getting rent, but the property value can also change.
That's a great analogy.
Now let's dive into short maturity investments or money market investments.
The short-term side of things.
Exactly what are some of the key options in this area?
Well, the most common one is just a regular deposit,
Okay.
but you also have certificates of deposit or CDs,
Mm-hmm.
treasury bills, bills of exchange, commercial paper.
So it's like a whole menu of options.
Right. Different flavors for different needs.
What are some key differences to keep in mind?
Imagine you make a regular 3-month deposit.
Okay.
You usually can't access that money until the term is up.
Right.
But with a CD, you can often sell it to another investor if you need cash early.
So a CD gives you more flexibility.
Exactly, more liquidity.
Then there are treasury bills. Those are bought at a discount.
Right, your return is the difference between what you paid and the face value at maturity.
So it's like buying something on sale and selling it later at full price.
Exactly, you got it.
And for many retail investors, they access the money market through unit trusts or mutual funds.
Right, these funds pool money from lots of investors.
To invest in a bunch of different things.
Yeah, diversified portfolio of money market instruments.
So it's like teamwork in investing.
Exactly, spreading the risk and potentially increasing returns.
Okay, that's helpful. Now, foreign currency deposits, they always sound tempting.
I know those high interest rates can be alluring.
But is it really that simple?
Not necessarily.
What was the catch?
Higher interest rates in foreign currencies are often offset by a decline in that currency's value,
So you might earn more interest.
but lose money when you convert it back.
It's like winning the lottery in another country, but the exchange rate eats away your winnings.
Exactly.
The book mentions those UK residents who borrowed in Swiss francs back in the 80s.
Oh yeah, that was a tough lesson for many.
They wanted those lower interest rates.
But then the Swiss franc appreciated against the pound.
And their mortgage payments went through the roof.
It shows how currency fluctuations can wipe out any gains from those higher foreign interest rates.
So be cautious with those foreign currency deposits.
Always weigh the risks carefully.
Now, for our last topic, let's compare money market investments to the stock market.
Okay, the battle of the returns.
I'm curious to see how they measure up against each other.
Imagine putting away £1,000 every year.
Okay.
After 20 years, the difference between investing in the stock market versus a savings account can be huge.
Wow, really?
The stock market historically has delivered higher returns,
What?
but it comes with higher risk.
So higher potential rewards, but also bigger potential losses.
That's the trade-off, the risk-return relationship.
But time is on our side when it comes to investing, right?
It is. The book mentions data from the Daily Telegraph.
Oh, yeah, I remember that.
The longer your investment horizon, the more likely stocks are to outperform deposits.
So for long-term goals, stocks might be the way to go.
Potentially. But for short-term, needs money market investments offer stability.
Okay, and you mentioned the equity risk premium before.
Right.
Can you remind me what that is again?
It's the extra return you can expect from investing in stocks
Okay.
compared to less risky investments like money market instruments.
So it's like a bonus for taking on more risk.
Exactly. And while it can vary depending on market conditions,
Right.
it highlights that potential for greater returns from stocks over the long run.
But always with that higher risk.
Exactly.
Yep.
Risk and return go hand in hand.
Okay, we've covered so much in this first section.
We have a lot to digest.
The fundamentals of interest rates, inflation, different money market investments,
Nominal and real interest rates.
discounts versus interest rates. It's a lot to take in.
It is, but it's all important stuff.
Now, before we move on to the next section,
Well,
I want to pose a question to our listeners.
okay, shoot.
We talked about how personal service was important for many investors in the past.
Right.
But in today's digital age, with all the convenience and technology,
Yeah.
how much weight do you place on personal relationships when making financial decisions?
That's a good one to ponder.
It's something to think about as we continue our deep dive into this world of interest rates and money market investments.
Absolutely. It's interesting, isn't it?
It is, like, you'd think it's all about getting the highest return possible.
Right, maximize those gains.
But the book suggests that for a lot of people, feeling valued by their bank or financial advisor, that was actually more important.
Yeah, that personal touch can really make a difference.
It's like choosing a restaurant sometimes.
Oh?
You're willing to pay a bit more for good service.
Even if the food's not the absolute best,
Exactly.
there's a human element to finance that we sometimes forget about.
People want to feel like their money's in good hands.
Exactly. Trust and understanding that goes a long way.
Makes you wonder, though, has that changed in today's world?
With online banking robo-advisors.
Yeah. Are people still looking for that personal touch?
Good question.
Or is it all about convenience and low fees now?
I think technology has definitely made investing more accessible,
For sure.
more efficient. But it's also created a sense of detachment for some.
I can see that.
There are still plenty of investors who crave that human connection,
Yeah, someone to talk to bounce ideas off of.
a partner in their financial journey.
It can feel reassuring to know you have a real person you can call.
If you have questions or concerns.
Yeah, like a safety net.
Exactly. So as you're making your own investment decisions,
Yeah.
think about what matters most to you.
Is it purely about maximizing returns?
Or is that personal connection something you value?
It's about finding the right balance.
Absolutely one that aligns with your values.
Now, the book also mentions a lack of innovation
Oh, yeah.
when it comes to money market investments.
Especially for retail investors.
Yeah.
Why do you think that is? Well, the authors suggest a few reasons.
Okay.
First, developing new products can be costly.
And time-consuming.
Exactly.
There's also this perception that retail investors are more conservative.
Yeah, less likely to embrace something new.
And maybe they don't fully grasp more complex products.
That's another assumption that's often made.
So it's like a vicious cycle.
Institutions hesitate to create new products, and investors are hesitant to try them.
But do you think that's changing?
I think it is, slowly but surely. There's a growing demand for alternative investments.
Especially among younger generations.
Right, they're more comfortable with technology,
More open to new ideas.
and they want their money to make a difference.
Yeah, like impact investing ESG funds.
Exactly, aligning their investments with their values.
So as that demand grows,
I think we'll see more innovation in the money market space.
it'll be interesting to see what develops.
It definitely will.
Speaking of interesting options, the book touches on the wholesale money market.
Ah, yes, the big leagues.
Right, where much larger sums of money are being invested.
Exactly.
Is there a way for retail investors to tap into that?
To get access to those potentially higher returns.
Yeah.
One way is through institutional investments, like unit trusts.
Okay.
Think of it like a VIP club for investors.
So you're pooling your money together.
Exactly, to access opportunities that would normally be out of reach.
So it's like leveling up your investment game.
Exactly. You're tapping into the expertise of professional fund managers and gaining exposure to a wider range of investments.
Okay, that makes sense. Now, as we wrap up this section, what are some key takeaways you want to leave our listeners with?
I think the biggest takeaway is that knowledge is power.
For sure.
Understanding these concepts helps you make informed decisions about your money.
Whether you're a beginner or an experienced investor.
Exactly. Taking the time to educate yourself is crucial.
It's like having a financial GPS guiding you.
Right. Helping you navigate those complex decisions.
And don't forget about knowing your own risk tolerance.
Yes, that's essential.
Your financial goals, Your values.
All plays a role.
Okay, so we've learned about compounding inflation,
Different types of money market investments.
the balance between risk and return,
The psychology of investing.
a potential for innovation.
And the role of personal values.
This has been a fascinating deep dive.
It really has.
Now, before we move on to the final section,
Okay.
I want to leave our listeners with one last thought.
Okay.
We've talked about interest rates and investment strategies,
All the factors to consider.
but ultimately it comes down to this.
What does financial security mean to you?
Is it about maximizing returns, building a comfortable nest egg, or something else entirely?
That's the question to ponder
As we continue our exploration.
of this fascinating world of finance.
Yeah.
It's different for everyone.
Right. Like, it's not just about having a certain amount of money.
No, it's more than that.
It's about feeling secure,
Comfortable with your finances
knowing you have a plan.
and feeling in control.
Exactly. And that's what we've been trying to do in this deep dive.
Giving people the tools to understand
The ins and outs of interest rates, money market investments.
all those important concepts.
We've covered a lot of ground.
We have from the basics to more complex stuff,
The importance of knowing your risk tolerance.
your financial goals,
Yeah.
your values.
It all ties together.
It does. It's all interconnected.
So I think we've given our listeners a lot to think about.
Hopefully some aha moments along the way.
Definitely. And remember, the learning doesn't stop here.
It's an ongoing journey.
Keep exploring, keep asking questions
And don't be afraid to seek guidance if you need it.
from trusted financial professionals.
Right. They can provide personalized advice.
Well, on that note,
Yeah.
I think we've reached the end of our deep dive.
It's flown by.
It has. Thanks for joining me on this exploration.
My pleasure. It's been a great discussion.
And to our listeners, thanks for tuning in.
We hope you found it valuable.
Until next time, happy investing.
Happy